So if you've been watching the markets, specifically the world of Chinese concept stocks.
The Zongegu.
Exactly, Zongegu. You've seen a really dramatic, almost immediate repair. And we are diving into a surge that seems to be almost entirely driven by one simple but, well, incredibly powerful idea.
The AI application narrative.
Right.
And, that narrative shift, it creates this central dilemma we really need to try and resolve for you today.
Okay.
Because when capital rotates this aggressively, shifting into growth stocks with this kind of velocity, the market just immediately splits. It splits into two camps.
And the question is
this widespread rally, this huge move in such a short time, is it just a fleeting speculative bubble? Or, and this is the important part, is it genuinely a sign of a sustainable trend, something driven by real, fundamental industrial change?
So to figure that out, we have been sifting through, well, everything. Analyst reports, financial news, deep dive research detailing these, frankly, explosive market movements.
All from mid-January 2026.
Yep. And looking at specific company performances, especially Alibaba.
Yeah, our sources are pretty comprehensive here. They detail the catalysts, what's driving the market, the company's capital commitments, and maybe most importantly, these conflicting ways of valuing these companies.
So our mission today is to understand how this brand new AI revaluation logic is just overpowering the really deep-seated anxieties that have been holding back these major Chinese tech firms for the better part of a year now.
It really is a battle. It's a battle between the ghosts of the old business models and the promise of this radical new future.
Okay, so let's unpack the sheer speed of this market repair, because it's truly astonishing.
It is.
Take Alibaba. The ticker is BIBAUS. On January 12th, it surged over 10%.
In a single trading day.
Yeah. Closing firmly above the $166 mark.
Yeah.
And that wasn't just a good day, right?
No, not at all. That was Alibaba's largest single-day increase in nearly a month. That is a massive statement of investor confidence. It reversed all that negative momentum almost instantly.
And it's so important to understand, this was not a solo performance.
Oh, absolutely not. The source material is really clear on this. The capital rotation is aggressive, it's sector-wide, and it's targeting any tech growth stock with, a clear path to using AI.
So beyond Baba, who else was catching that wave?
Well, we saw really significant gains from other hot concept stocks across the whole ecosystem. I was talking about Baidu, JD.com.
EIDU and JD.
Right. And also Xpeng, Kingsoft Cloud, Tello Education, and even Bilibili.
BLAL, yeah. And even the big Hong Kong-listed giants were getting in on it, right?
Absolutely. Their peers, like Kuaishou and Tencent, also recorded these substantial gains. The market is, it's effectively painting the entire sector with the same AI brush.
Which sets up this immediate gut check challenge for you, the investor, to chase or not to chase. Because the enthusiasm, it's palpable and the charts look great, but the pain from those previous sell-offs, the ones driven by macro fears, that's still really fresh in everyone's memory.
So to answer that question, you have to understand the collision of forces happening inside the biggest name of them all, Alibaba.
Right.
Alibaba's recent stock movement is just the perfect illustration of this market conflict. Back in Q4, the stock hit a high of, 192 on October 2nd?
Yeah.
Only to fall by 18% after that, and then, boom! January hits and you get this massive reversal.
It's a dramatic conflict between two completely competing logics for how to price the stock.
Exactly.
So let's start with what was pulling it down. The sources call it the downward logic, or e-commerce anxiety.
Yeah.
What were the analysts seeing that caused that 18% drop?
Well, it really stemmed from a genuinely deteriorating outlook for their core business.
The e-commerce side.
The e-commerce side. Analysts, even major players like Morgan Stanley, they cut their target price from 200 down to 180.
And that was almost entirely based on weakness in e-commerce.
Almost entirely. They were citing general consumer weakness, soft consumption, and this high base pressure they expected to continue well into the first half of the 2027 fiscal year.
And that consumer weakness, it isn't just a feeling. There are real, tangible numbers behind it.
There are. We're talking about an environment where November's online retail growth, when you measure it by the social retail metrics, was only 1.5% year over year.
1.5%.
Yeah.
That is a painful slowdown for the world's platform leader.
It's a huge slowdown. And on top of that, there's a major concern around instant retail or flash buying. The market was scared of Alibaba's stated commitment to achieving absolute market first in 2026.
Okay, let's pause on that. What does absolute market first actually imply to an investor? What's the fear there?
It implies what the sources call stock-based competition. Basically, a high-volume, low-margin fight for market share.
A race to the bottom?
Sort of. Alibaba commits to achieving dominance, which means aggressive subsidies, promotional spending, and that directly sacrifices short-term profit. It just drags down all the margin forecasts.
So the market punished them for fighting that war?
Yes. They were punished for fighting the red ocean war of e-commerce infighting, and that led to that typical risk aversion we saw in Q4.
So the market was punishing them for fighting a past war, while at the same time completely ignoring the revolutionary future they were building. And this is where it gets really interesting.
The upward logic.
The AI revaluation.
Yeah.
Capital just rapidly shifted its focus away from that depressing red ocean and into the blue ocean of AI monetization potential.
And this is where the sheer difference in growth potential it completely overwhelmed the downside fear.
Right.
Alibaba is now widely viewed as China's best AI enabler. Goldman Sachs projected that Alibaba cloud revenue growth is set to accelerate to 35% or more year over year.
Up from 34% in Q3.
Exactly. That cloud business suddenly became the dominant factor in how people valued the company.
Okay, but hold on. 35% growth is excellent, no doubt. But is that acceleration really enough to offset the systemic consumer weakness and that subsidy war happening right now in their core business?
That's the critical question.
How quickly does the market expect cloud to eclipse e-commerce as the main engine?
Well, the market justifies the premium by looking at their AI success metrics and their capital commitment. First, look at their technical lead. The Tongyi Quanwen series models. They've accumulated over 700 million downloads on Hugging Face.
As of January 2026.
Right. That makes it the highest downloaded open source AI series globally. That signals massive developer mindshare, ecosystem dominance.
And that kind of technical adoption, that should translate directly into enterprise application success.
Precisely. And we see that. We see rapid, quantifiable adoption in their applications. The Ant Afu model, for instance, it hit over 30 million monthly active users.
30 million?
And surpassed 10 million daily health queries within just 1 month of its new version launching. That level of rapid, high-scale deployment is what truly justifies a premium.
And the commitment here isn't just technical, it's financial. At their recent cloud conference, Alibaba made a really clear statement.
A very clear statement.
They're substantially increasing their capital expenditure budget for Alibaba Cloud. And their stated target is incredibly ambitious.
It is. To capture 80% of the AI cloud market's incremental growth in 2026, they are aiming for nothing short of dominance.
They are essentially betting the farm on the future market.
They are, and they aren't limiting it to just domestic growth. The overseas business, which currently serves over 220,000 exporting enterprises, that's expected to become a core growth driver.
Potentially boosting margins above 15%.
And resulting in a 3-year revenue CAGR, a compound annual growth rate of over 30%. And when you put a 30% growth CAGR next to a 1.5% retail slowdown.
The market is choosing to prioritize the 30%.
That's the mechanism of the revaluation. That's it right there.
So that narrative shift was powerful, but it wasn't random. The sources we've looked at point to 3 big industry events that acted as these immediate synchronized catalysts. They basically flipped a switch and set the market on fire in early January.
Right.
What triggered this rush?
The first one is policy leveling up. And this is fundamental. The government officially elevated AI Plus from, just a collection of company actions to a full-on national strategy for industrial upgrading.
And when a government makes a move like that,
it changes the entire landscape.
So how does that actually translate into capital flowing into these stocks?
It significantly reduces regulatory uncertainty, which, let's be honest, has plagued Chinese tech for years, and it promises a much more supportive policy environment.
So this isn't just cheering from the sidelines.
No. This means better capital expenditure support, potential future fiscal subsidies, and credit support. Capital knows that if the government is committed to AI, the funding taps will stay open.
Okay, so that's catalyst 1. The second one provided these critical valuation anchors. And some massive disruptive forecasts.
Exactly. On the valuation side, we saw a really strong stock performance from large model companies like Minimax and Zippo listing on the Hong Kong exchange.
And their valuations provided these tangible benchmarks for the whole sector.
Yes. Before those listings, the market was basically guessing. Now it has recent comps to work from.
And then you have the influence of, well, specific personalities in their forecasts.
Right. The market got a major jolt from Elon Musk. He made this really aggressive statement in a deep interview,
I remember this.
predicting that AGI, artificial general intelligence, could be achieved by 2026.
This isn't just news. This drastically compresses the market's expected timeline for everything. Application maturity, monetization.
Absolutely. It creates a massive fear of missing out, a FOMO that's based on time.
Right. If AGI is coming that fast, you can't wait 2 years to see if the tech works out.
You have to buy the infrastructure and the application leaders now. It forces an immediate, aggressive revaluation of the assets that are perceived to be closest to that finish line.
Okay. And the final catalyst. That focuses on technical breakthroughs and global validation. Domestically, there was a serious signal of technical competence.
That signal came from DeepSeek. They're expected to launch their V4 model before the 2026 Spring Festival, and they're specifically targeting the high-value enterprise code generation market.
And they're claiming internally that its performance surpasses established global leaders.
Surpasses Claude and the GPT series models. Now, that internal technical validation suggests China isn't just copying anymore. They're genuinely innovating at that foundational model layer.
And globally. Was there a signal there too?
Yes. Overseas validation came from M&A, the proposed acquisition of a company called Manus. It just exceeded market expectations for both its valuation and the transaction amount.
Why is that so important?
Because it demonstrated that the AI application layer, the software and services built on top of the models, has independent, tradable, and really high value. This justifies the strategy of the Chinese tech giants who are focusing so heavily on integrating AI into their existing massive user bases.
So after absorbing all of these catalysts and this dramatic market response, what's the ultimate conclusion here? I mean, is this it? Is this the definitive inflection point? Have we reached that legendary application singularity?
Well, if we connect this all back to the bigger picture, the consensus among analysts is nuanced. The ultimate AI application singularity, that moment where AI becomes ubiquitous, perfect, universally profitable, that hasn't arrived yet.
Okay.
But, and this is the crucial distinction, the industry has entered a critical tipping point for application success.
That sounds a little like splitting hairs, but if you're deciding where to put your capital, I imagine that difference is everything.
It is.
So explain the technical reality behind that tipping point.
It really speaks directly to technical maturity. AI has crossed from relying on, let's call them single-point breakthroughs, where maybe one feature was great, but the rest was clumsy, to achieving systemic maturity.
And that's based on the models developed in 2025.
Right. We're looking at models like GPT-5, Gemini-3, QuenMax. They now possess these core commercial capabilities that just didn't exist widely before.
Give us an example of those capabilities and why they matter so much for monetization.
Okay, so take tool calling. This is key. Tool calling means the AI can reliably interact with external systems like enterprise databases, inventory APIs, financial software.
To actually complete complex tasks.
Exactly. Then you have multimodal understanding, which lets the AI process images, video, text, all of it seamlessly. And finally, autonomous planning.
Which means the AI can break down a high-level goal into steps and just do it.
Do it without constant human intervention.
So the technology is no longer just a research curiosity. It's robust enough to be plugged directly into enterprise workflows.
Exactly. And this systemic maturity, it changes the market imperative overnight. The focus is no longer on who has the biggest chip stack or who has the most parameters.
It's all about profitability.
All about profitability. The market is now willing to grant that massive accelerated premium only to companies that can prove in their actual financial reports that AI has contributed revenue.
It's shifted from R&D promises to monetization receipts.
That's the new game.
So that clarity, that need for commercial profitability, it forces us back into a posture of, critical thinking. We've seen the upside, but what are the key risks the sources highlight that could swiftly derail this whole revaluation?
The risks are significant precisely because the enthusiasm is so high. Risk number one is expectation overrun. which is really just a fancy term for anticipatory trading.
People getting ahead of themselves.
Way ahead. The market enthusiasm, driven by the policy support and those aggressive AGI forecasts, might be running significantly ahead of the actual implementation speed inside of real companies.
So the valuation is pricing in success next month, but the real-world deployment could take 6 months or a year.
Precisely. And risk, too, is commercial sustainability. Many of these AI application firms, including some that saw huge gains in January, are still firmly in the investment phase.
Right. They're spending money, not making it.
And some have openly stated they lack a mature commercial model. Zero current revenue contribution from AI. So if their initial attempts to, say, turn those 30 million monthly users into paying customers, if that fails to materialize into reliable earnings over the next couple of quarters,
a rapid valuation pullback is highly possible.
Very possible.
And this really highlights how the investment logic itself has matured so dramatically since 2023. It's not enough anymore to just invest in compute and models.
Right.
2026 demands two things: a scenario moat and a proven scalable profit model.
And that's why the market is mapping these core Chinese assets onto successful overseas AI application firms like AppLovin. They're looking for companies that have massive existing data sets and established consumer and enterprise scenarios where the AI can be deployed immediately.
It leads you directly to the big three.
Directly to the core assets that dominate their ecosystems: Alibaba with e-commerce plus cloud, Tencent with social plus gaming, and Baidu with search plus auto.
These are the companies that are perceived to have the necessary scale, the application layer, to jump from that tipping point to the singularity.
They hold the data and the distribution, and right now that's arguably more valuable than the model itself.
Now, if you, the listener, find that picking individual stocks is just too difficult, I mean, trying to track every specific AI revenue stream for these giants,
it's a full-time job.
It is. The sources detail a really excellent alternative strategy. You can invest through China Concept ETFs. We're talking about funds that give you that broad, diversified exposure, like YN, CWEB, KWEB, and FXI.
Yeah, they offer a way to bet on the overall AI thematic repair without staking everything on a single company's ability to execute on its specific cloud revenue target.
So to wrap up, what's the core tension we're leaving our listeners with?
I think the core tension is this. The market is reconciling a persistent, real anxiety over core businesses like slowing e-commerce growth with this compelling, almost euphoric excitement over new growth drivers, specifically AI and cloud.
It's a battle for the soul of the valuation model.
It really is.
And that dramatic stock bounce we saw in mid-January, especially in Alibaba, it reflects the market's decisive answer.
For now, at least.
For now. It is aggressively prioritizing the future cloud and AI value over the present e-commerce anxiety.
Yeah.
It has decided the blue ocean potential is simply more valuable than the red ocean certainty.
So if underlying AI models like QuinMax really have achieved this systemic maturity with tool calling, multimodal, autonomous planning capabilities, we have to ask a final provocative thought. What is the single greatest risk preventing these advanced technological capabilities from translating into immediate and sustainable commercial revenue?
The answer has to lie somewhere between the speed of expectation and the maturity of that profit model. Something profound for you to mull over until our next deep dive. Thanks for listening.